Welcome to Market Thursday. We are November the 19th and I'm in London tonight. So quickly for the newcomers, just a quick background on what I've been doing so far in my career. So I started to trade in 2000 in Paris as a cash equity trader for Pierre Charon Gestion. Then I work a bit for DTM, another asset manager. Then from 2004 to 2008, I worked for Reflation Capital Management in London, working on the long-short product and on the long product. In 2009, I started to work for Infinity Capital Market as a prop trader, where I ran a long-short book, no constraint, absolute return mandate, no regions, could trade whatever I wanted. And I did that from 2009 to 2018. In 2014, I discovered the world of mentoring people and trading education online. So I worked for another company and I left this company in 2017. I restarted in my own mentoring program in 2018. And since 2018, I've mentored more than 50 people from this company, my own company. And last year in October, I launched a 4x4 video series. So as usual, what are we going to be covering today? So today, during this Market Thursday, we're going to be looking at situation across asset classes. So that's something we do week after week. Then we're going to be discussing the 2021 S&P 500 earnings because, obviously 2021 is starting tomorrow or in a month's time. And that is really what is important now is what's going to happen in 2021 over the first 6 months and over the year. Then we're going to be looking at something that the market is really looking at these days since we had the election and since we had the vaccine pipeline since last Monday, 10 days ago, which is factor rotation and sector rotation. So there's going to be a lot of talk about rotations, and I'm probably going to be repeating myself as usual, but that's as much as possible to help you on the understanding of what happened and what might happen in the future. Then we're going to end with a Q&A session if you do have some questions about what we are covering today or some other issues. So let's start with the asset class performance. As you remember, a month ago, I included the Bitcoin in this asset class performance, and actually I was quite lucky because since then the Bitcoin, when we started to look at it, was at 1200, now it's at 1800, 1900. But the asset class performance since the start of the year, we know now that Nasdaq is really the big winner, up 31%. And on the other end of the spectrum, again, we do have WTI. In terms of currency, so that is here, the dollar has been weakening between 3 to 6%. So weakening dollar. Otherwise, if we are talking stocks, emerging market have been doing pretty well, between 5 to 10%. Europe has been really struggling and has been the weak part. I mean, Bovespa is not, but Europe has been struggling. If we look here, here you could have a bit of Europe here, which is the FTSE, which is really the laggard so far. And the Russell 2000 has been bouncing nicely since the election. On the week to date, even if last week that was another webinar that I did on Saturday. On the week to date, you can see that actually the market is a bit consolidating. So there has been some moves up and down. So we went up on the vaccine, so the last 2 Mondays, and since then we have been giving back most of this of those wins. So this is why we get the S&P, the Nasdaq. So that is the performance as of yesterday, week on week, where the S&P and the Nasdaq actually week on week was flattish. So 2 days after the election, the S&P was flat, and clearly the big winner. And if you are on Twitter, if you're on social media, and you haven't seen that Bitcoin is up big time, then you are probably not following the right people. So there is a lot of noise, rightly so, because Bitcoin has been the big winners. The big winner now it's making a new time high, and new time high, which is exactly the same as a couple of years ago. Here, I really, if you are in it, good for you. If you're not in it, be careful, because, you know, in 2018, 2019, after the drop, I had many people coming at me, and they are still recovering from Bitcoin, because, you know, between the moment it went from 1,800 to 3,000, people had to cut because there was some margin calls. And so be careful if you are a newcomer and you don't know much about risk management, about concentration and leverage and trading Bitcoin, because even if it sounds pretty good, and there is always downside in trading those things without having any risk management. So be careful. But what is interesting is, after the election, despite what people were saying that with Biden is going to be the end of the world, the market has not yet reached the end of the world. So be extremely careful when you read people, when people are telling you the end of the world is coming, that Democrats are really bad or Republicans are really bad. There is always, you should take everything with a pinch of salt. As I've been saying for many times, yeah, and I'm on the record saying that I think the market, that's the best situation for the market, to have both a Democrat and Republicans, meaning divided and not full power. The market seems to like it. But that's as long as you have not experienced those times, you know, it's you want to trust what people are telling you online or on social media. So asset class performances, here we are looking at the sectors, the 11 sectors of the S&P and the S&P year to date. Every single week when we were discussing, and when we are discussing, we are looking at XLE, which is the energy, and that was really the laggard, which is down 42%. So that's the week to date. If we look at the week to date, actually we know that XLE has been bouncing quite nicely. It's around $36 or something like this, and it went to the $28, $27. So it has been bouncing 30 to 40% from the lows, because, as we're going to be covering later, there has been a lot of rotations. Some losers have been recovering on rightly so, the vaccine coming, and it's going to help the sector. But overall, on the picture, we should always be looking at the different time frames on the year-to-date performance. XLE is down 42%. Technology, consumer discretionary, thanks to Amazon, are doing very well. And if you look at what has been happening over the last week, again, there has been a lot of noise, but not much is really moving, except 30%, let's say, of the stock. So we are talking energy here, we are talking industrials and financials. We did pretty well, and that's something we're going to be covering in the next slides, when we're going to be looking at the technical analysis. Now we are looking at the picture with the bonds that we have here. There is US, UK, Germany, and Italy. So bonds, in terms of yields, the yields have been coming down on the US 10 years, US Treasury, on the bond, on the gilt, and the BTP. So the whole reflation trade has been fading a bit. It is still if you look at the, not the US 10 years, but if you look at the 10 versus the 2 in the US, we are back to the level pre-election. So kind of fading. What is interesting is the VIX. Again, we have been covering that actually since January of this year. If you look at what I've been saying since January 2020, talking about the outlook for 2020, there is, as always with elections, a spike in the implied volatility, because investors, market participants, are overaging themselves. And as there is a catalyst, the implied volatility and the contract are spiking. So we went up to 38%, 40% recently, 10 days ago, and now the whole yield curve is coming down massively. We are at 24%, so that was as of yesterday, but we came down massively. Again, look at the long-term picture of the VIX. The VIX on average is trading around 19%. And, you know, in 2016, 2017, it was much, much lower. Again, I'm not saying that this is where it should go heading, but clearly after the election, there was strong possibility that the implied volatility will come down the way it has come down. In terms of winners and losers, again, there is a lot of probably some names that you have been trading based on the reopening of the economy. And I think here, this one is bouncing nicely, 15% on Muddy Waters, making a call short yesterday. But that is for the asset classes. For bonds, VIX, which is volatility, even if I know this is not an asset class, still I'm looking at it because I think this is important. We're going to be looking later at the steepening or the non-steepening of the yield curve. Another chart that I would like to discuss here, which is the retail sales that we had this week. I think it was a couple of days ago, and I put the core retail on the left-hand side, months on months. So yes, around March, April, that was the end of the world. Since then, we have been bouncing nicely in May and June. But as you can see in October, the months on months is flattish. So there has been some slowdown in the strong recovery that we have seen over the summer, which can be explained by different factors like elections, US elections, that can be explained as well, but the necessity of having a new fiscal stimulus. So as you remember all, in October, there were a lot of talks about, you know, making a fiscal stimulus between Democrats and Republicans. They didn't find a deal, rightly so, because the elections were too close. And there were talks between 1.5 to 2 trillion. I think the market but moved a bit on some news of some fiscal stimulus coming back on the table. So that is clearly something to watch for the next months, because something has to be done. And why is it important to look at this picture? On the right-hand side, we got the non-store retailers, which is the online business, and the online business months on months was up 3%. So most of us, we have been sitting at home or working from home. And we know that online is benefiting massively from this COVID. But what is important is, in terms of catalyst, what is going to happen in the future. And so if we look at what happened recently, this is something that you can find online. If you just type Chase Consumer Card Spending Tracker, it's going to be on JP Morgan website. I think it's every week they're going to give you the traffic from consumer card. As you can see, at the end of October, start of November, there was a bit of a dip, not a massive dip, but since then we have been bouncing. Really the question is how the US consumer is going to be doing in the next 6 weeks. And that is really important, because next week we get Thanksgiving. And around Thanksgiving, and with Black Friday, Cyber Monday, and Christmas coming, the last 2 months of the year, the last 6 weeks of the year, are extremely important for US consumption and US retailers. So clearly you want the US consumer to be in a good shape, and maybe not in good shape, but in a good mood at least to consume. And that is important that we see some bounce in these numbers, because otherwise you could assume that the GDP, the US GDP, could be lower than the expectation. As always, looking quickly at the Fed balance sheet and the ECB balance sheet. So Fed balance sheet is not moving that much. ECB is moving much more. They are pretty active. But what is important is to be looking at the catalyst. And for the ECB and the Fed, so this is not for next week, this is not for the next 10 days. But if you are thinking about what's going to happen before Christmas, on the 10th of December, there is the ECB coming, and the ECB should be coming with a big bazooka. So Lagarde has been announcing quite early in September that it was actually too early for them to be doing something. Now the market is expecting them to do something big. So you have extra stimulus coming from the ECB on the 10th, and 1 week later on 15th and 16th. So Tuesday and Wednesday, you get the Fed as well, Fed meeting, and that has to be significant. They will probably come with something because the fiscal stimulus, both in Europe and in the US, have been slow to come, and we have as well a second or third wave of COVID coming and ongoing, meaning that even if we are better dealing in terms of medicine and in terms of capacity with those new cases, that implies a half closing of the economy, which is obviously impacting the GDPs and the economy. So if that happens over the next 6 weeks, that is another wave of closure, which is going to impact the economy. If you look at the numbers for next week, again, the market is going to be very quiet. Why? Because Thursday, you get Thanksgiving. So the market is closed on Thursday and it's half open on Friday. So if you think about, I mean, I'm not American, but Americans most of the time will be traveling back to their families. I'm not sure that they will be doing that much this year. But that means literally from normally the Wednesday evening to the Monday morning, market is extremely quiet. And because in the Europe, we are following massively US, you should expect a quiet market at the end of the week. And in terms of numbers, economic numbers, we don't have that much numbers. So there is not much catalyst now. We should be looking at December. And more importantly, what is going to be in 10 days' time, Monday, Tuesday, Wednesday, what's going to be the feedback from the US retailers about consumption in the US across this Thanksgiving. Do I have another one? Yeah, let's go now into the Excel spreadsheet where we're going to be doing a bit of technical analysis. Where is my, here we are. So let's start as always with the S&P. So the S&P, the long-term picture is we are still trading below this long resistance. We broke recently this resistance that is again making a line out of 2 or 3 points. You need to be careful, but as long in the short term that we stay above this 35.10, 35.20, the market is bullish. So that is for the S&P, keeping in mind that the resistance is not that far from here, at least the first resistance. The Nasdaq has been struggling as well, so there is a lot of consolidation. In terms of seasonality, the last 6 weeks of the year are normally positive, but that is still to be with a pinch of salt. And you remember a couple of years ago when the market dropped massively at the end of the year and bounced around the 23rd or 24th of November. What is interesting is to see that the Russell, which is small mid caps, is now making new highs and has been breaking the level of under 1740. And clearly, again, that is something that we're going to be covering when we be talking about rotation. Rotation has massively benefited small and mid caps in the US. In Europe, because we should be talking a bit about Europe, the DAX is close to this midterm resistance or midterm top. Euro stocks, there is a bit less color. I think the Euro stocks is really hard to trade. Why? Because it's only 50 stocks and there's a lot of financials into it, even if the financials are smaller than before. Philadelphia stocks, here you should be looking at logarithmic. So logarithmic, we are below the trend now, but it's still trending nicely. Currencies, so that's the one that I always show you week after week. If we do a euro dollar and we put a weekly one, I think this is the chart that I end up with. So being along the dollar here versus the euro, that is a tough, a big call to make. I know that people that are losing money on that trade on Twitter are very vocal, but the chart is telling me so far that being long the euro is a better trade than being short. Something that we cover, the Turkish lira, I think it was 2 or 3 weeks ago. When we look at the chart, we said that these levels of candles were telling us that probably we might have been reaching an intermediate high. Since then, we have been coming, so the Turkish lira has been strengthening. Today it has been strengthening even more because they raised the rates from 10.25 to 15%. So that has been helping. I think there was a lot of positioning in that currency. Another currency that I think is interesting and where technically there is more to say is the Aussie. So if we break the 73.50, I think it could be interesting. On the downside, it's 17. So that means you have a range at the moment at 3-4%, and that's in terms of trading interesting to look. Sterling has been strengthening. We discussed the possibility of the sterling strengthening, and it is happening finally. Brexit or no Brexit, the deal has to come. I know the deal has been expected for the last 4 years, but we are getting closer. Bitcoin, you know the chart, so I'm not going to bother you with the Bitcoin. And let's look now at yields. So US 10 years, you remember when we discussed the reflation trade. So we had a lot of ups and downs. So actually, if you think about the size that is trading around bonds, there has been a lot of ups and downs over the last couple of weeks. So I'm pretty sure that the swings in P&Ls have been pretty big. Question from Mark on the Brazilian real. I don't have any real view, to be honest. Will I put a euro versus Brazilian real? I will put USD versus Brazilian real. If you look at the fundamentals of Brazil, actually what was interesting is the ISM, the PMI manufacturing and services were pretty good. So a lot of emerging markets had very good leading indicators, and the economies are bouncing nicely. I think the last PMI was not as strong as before. So you bought something here, you bought something there. Yes, if you bought some nice place, and if you know where to buy, that is a different. I think the demographics are really good for Brazil in the long run. Politics, I'm not sure. Look, I'm not going to pretend that I'm a specialist of Brazil, so probably better for me to stick with where I'm better. If you look at the reflation trade, the 10 years versus the 2 years, which is the reflation and the steepening of the yield curve. So Democrats, non-Democrats, Democrats using a lot of deficit, meaning it's going to be reflation trade. So that was the call that was made since the end of September, start of October, when we went from 60 bips to almost 80 bips. Since then, we have been coming back a bit. I'm not sure that the Fed will lack. I think the Fed will lack as much as possible to keep rates under control. Having a steepening is good for banks. That is something that we're going to be covering later, looking at the short-term time frame, mid-term time frame, and long-term time frame of the steepening of the yield curve. Let's go. I think one of the charts that is interesting is the high yield HYG breaking. That you could argue that the 88. I mean, we are not talking like huge gain. If you go from 86 to 88, that is 2.5%. So it's not like again, something that I should have mentioned. All that I'm saying, are not investment advice. So that is for you to make the job and think about, the process and generating ideas. I'm just, trying to share some of my views. That doesn't mean that obviously you need to put position. So high yield doing better. They broke an important level at 85. Emerging market. If you ask anyone, and their mothers what they think about emerging market, they will tell you that this is the place to be in 2021. If I look at this chart, so emerging market is 50%, 60% China. So yes, China is doing very well. We all know that it has been outperforming the rest of the world for the last 9 months. So this is why emerging market has been doing so well. If we think that there is tons of bonds that are maturing, I think it's 7 trillion or more in emerging market, that might be an issue. If the world is slowing or not as strong as before, that might be an issue. So emerging market, strong, you know, if you, I mean, I went short at 37 with put and that didn't work out. And here I should not say that because normally on social media, you only say that you're doing good trades. But emerging market, I'm not sure now at the moment that if that is the call. Let's jump now into commodities. I think the gold first, because I know that many of you might have a gold position. So we had the fake here, the bull trap that was at 1900, went to 1950 just before the election. We came back. So now we get this resistance, this consolidation, if you want to do another one. So that is probably something around here. So as long as you stay above this 1850, you're fine as a long. Otherwise, you know, the next move down is 1740. So that gives you another $100 or more. So 5 to 6%. Commodities, I like to be looking at CL, which is WTI. I look at the CL2 just because CL1, as we said, has been distorted with the sell-off in March and April. CL2 or WTI, if you think that the vaccine is going to help the economy, and it's going to help the economy, that should rebalance the oil market. Having said that, there is still a huge imbalance between supply and demand because there has been a lot of storage, and the demand is probably 5 to 10% of where it was a year ago. Having said that, at 6 to 12 months, this glut is gonna might disappear. So if I were you, I will be carefully watching the 44 levels on WTI, because if it goes, it's gonna go quickly. We are in a market where everyone is doing the same thing at the last minute and waiting for the last minute to do something. So watch this 44. For the copper is still in the same market. It's trending nicely and up. And I want to move into stocks where for the copper we get something that we mentioned. I think it was 3 or 4 weeks ago, which is Freeport, which is giving us the same kind of story, trending nicely, going up and up and up. So those are some of the few names that I'm looking these days. So Baba. Alibaba, NIO, I traded NIO over the last couple of days. Zoom, so Zoom, you should be looking at the logarithmic chart. I think it's now trading below the trend. KWR, which stands for Quaker Chemicals. So that is something that I don't know, for those, maybe some of you watched the webinar in July. So at the end of July, I did a webinar for ID generation, looking at ISM, manufacturing services, and the whole stuff. And we look at chemicals, and we said, you know, chemicals based on recovery, based on as well the chemical index barometer will be doing better. So that was a slow recovery, and we digged from this chemical being bullish chemical, and we digged into the sector. And we found some recovery names, some cyclical names, and some fundamental names that we liked or didn't like. So KWR came out as a good story going into 21. And I think we looked at it when it was around 190.95. Okay, so it went to 170 bonds, and now is at 260. So what you have is a story where your downside was 1, your upside is 3. That was around July. So if you think about the ISM, manufacturing services, very often that gives you a good leading indication 3 to 6 months for ID generation like this one. So you need a bit of patience, but that's one of the charts that I think it's interesting because, you know, over the last 10 days, it just went through the roof. Quickly, as well, I just want to mention the XLI that is trending nicely. There is XLK. So anything that is cyclical has been doing pretty well. In terms of other names, some strategies that I'm looking at, mentioned that in the past, is breakout. So today I've been looking at SSNC. There is Plan as well that is making new highs in significant volume. And G is one of my mentees, is very long the stock because he bought like many call 8 and 10 January when it was trading at 7. So that is some of the stocks that I'm following, different strategies, again trying to generate different strategies and different stream of ideas. Let's go back into the slides. If you have questions, maybe we can do something that is a bit more interactive than usual. And I'll try to look and answer your questions. Why are we looking at the S&P earnings? Because we are November, December 2020, and we would like to be looking at what's going to happen next year. So here we get the picture since 2008 telling us, about how the S&P earnings have been delivered so far. So you have, if you look at normally a chart, so that would be something like with a slope, and in between you have this COVID, and you have some as well as outliers. Those outliers could be 2018, 2019. Why? It's not because, again, the economy was just way too good. It's mostly because the Trump administration reduced taxes. So mechanically, earnings went higher, but what is interesting is to see now that the market participants are expecting $165 for the S&P 500, so versus a market that is trading at 3,600. So roughly that gives you a 22 times EPS, okay, for this year, for next year. And as well, what is interesting is to compare this 157 to this 165. I think we all agree that 2020 was an horrible year, and we need to know if we have a V-shaped recovery. As we can see here, we clearly have better than the V-shaped recovery. So this is what the market is pricing at the moment. When we look at the S&P 500 2021 earnings, we need to be looking at the 11 sectors and what is expecting to be doing well over those 2 to 3 years. Healthcare is really, with IT, are the biggest winners. And guess what? Those are the two biggest winners over the last couple of years in terms of sectors. So XLV and XLK have been the big winners. So there is a huge correlation between earnings growth and stock performances. On the other hand, the energy is the loser, but we have sectors that actually are recovering nicely, like and sectors that are cyclical. So materials are doing well, industrial a bit less, but as we're going to see later, industrial are expected to recover massively next year. So S&P 500 here, sectors EPS 2019 versus 2021 in terms of percentage. And again, all the losers or the sectors that have been outperforming massively, like energy and financials, are the ones that over those 2 years are really struggling and have recorded negative earnings growth. On the contrary, healthcare, IT is doing well. If you look now at S&P 500 earnings growth for 2021, the big winner is industrial. By definition, if you have a US economy recovery, so that means that industrials should be the big winners, and XLI, XLK are really the one to monitor. So I strongly advise you to be looking at two things, looking at the XLI and the XLK on a standalone basis, looking at the chart, looking in terms of relative term, so not absolute, but relative, you put that versus the S&P, versus the SPY, and to make ID generation, you look at what you have in the industrial, okay, so Inside the industrials, you're going to have the sub industries, or industries, and which industries could be benefiting or have been lagging so far in terms of ID generation, and the same for XLK. And for me, that is, when I did the ID generation, when I mentioned the chemicals, that's the way of doing it, looking at what's inside an industry, a sector, meaning the 3 to 5 industries that you have, and you're going to be trying to find the names that you like based on fundamental analysis. Here, quickly, this is a chart. I think it's not a chart. It's a graph from let's say don't want to be misleading you. Goldman Sachs on the expectations. So we the numbers that we had before were from S&P. Here the expectations are 175, so $10 above. But you get the ideas from here. You're growing 10% in 2022. So a nice recovery, and I think Goldman is expecting. So yes, Goldman Sachs is always too positive, because we know that they are salespeople. So they like to sell things and make people believe that the world is going to be great, and they sell. But still, this is where is the consensus, and I just wanted to put this consensus. Let's jump now into the topic of the month, the topic of these weeks, and the topic of these days, which is rotation. So we have several kind of rotation. You have sector rotation, you get factor rotation. Factor rotation is the style of investment that you have. If you do value, if you do growth, and we know that over the last 10 days, growth has been extremely strong and outperforming value like there was no tomorrow. So this that is the one of the chart coming from the Global Fund Manager Survey from Bank of America that is coming every month, and which is asking market participants, what is your positioning? You can be playing it either the way because you're following the trend, or you are contrarian, but that gives you a bit of understanding what is the positioning. So the net percentage here of think value stock will outperform growth. So we are quite high, but as we can see, we could go higher. So we are halfway to this value will beat growth. Again, those talks of value outperforming growth have been around since the start for the last 5 years. In 2020, in January, I mentioned that this topic as well, saying that it was clearly something to monitor, but nothing happened for 9 months. And actually the widening since March has been quite large. And factor rotation value growth comes hand in hand most of the time with the yield curve expectation, the steepening of the yield curve, or the flattening of the yield curve. So the yield curve, you will take most of the time the 10 years versus the 2 years. And here, this is the expectation of what markets participants were expecting in the past with Lehman, the taper tantrum, election in November 2016 and November 2020. So again, I discussed that many times when we covered elections. When Trump came into power, we had banks going up. We had banks going up for two reasons: on deregulation and the steepening of the yield curve. So the steepening of the yield curve and yields going up happened for 4 months, I think, until February 2017. Then it came down again. Why? Because the economy was not firing like crazy. And more importantly, inflation was not, core PC was not trending way above this 2%. So now, if you look at the yield curve expectations now, expectations are really, really high. And as always, when expectations are so high, it doesn't take that much for those trade to reverse to the mean. If you look at gold, gold that was, extremely bullish for most people at 1950, 2000 and above, when you shake those hands, it comes back to the mean quickly. So if we look here at the US 10 years versus the 2 years, so this is since 1989, so you have 30 years of chart. So here it's very correlated with the US economy. So when you had the crisis in 2001, but then you have the steepening of the yield curve. Same in 2007 and 2008, you have this big trend up. So if you think that it might be the same, and that is probably, and you are these days around 65 bips to 70 bips, you could be saying, you know, over the next 3 to 5 years, we could be targeting, you know, 200 bips move. If you have this 200 bips move, that is very positive for the value trade versus growth. There is a strong correlation between value and the US 10 years. So here, this is a chart from Bank of America, where we see the correlation between the Russell 2000 divided by the Nasdaq and the 10 years. So when the US 10 years is going up, the Russell is massively outperforming the Nasdaq. And on the contrary, because the US 10 years kept on coming down over the last 20, 30 years, or at least over the last 2 to 3 years, the Nasdaq was outperforming the Russell. Similar here, this is the chart that I've been doing on the longer time frame, where in blue we get the Russell 2000 divided by the Nasdaq Composite, and in orange the US 10 years, where on the left-hand side this is Russell, and on the right-hand side this is US 10 years. So there is correlation. If you think, again, that the US 10 years will keep on going higher, and if it will go higher if you get inflation, if the economy is doing better. And here, this is really a tough call because, you know, inflation, we discussed that before. On one hand, there is a lot of liquidity coming into the system, but you can argue that with what is happening with the economy, that could be deflationary. But there is a strong feel that because of fiscal stimulus and monetary stimulus, for once, there might be inflation coming. If there is inflation, that is positive for value versus growth. So what did I put here? I put so yes, I put the Russell. That is the Russell versus the Nasdaq Composite. So the first chart, the top chart, is the long-term picture. So that is value versus growth. And as you can see, value versus growth has been underperforming since 2007, 2008. I'm not saying that one point is the bottom, but what we need to do as much as possible is to compare the long-term picture over 20 years and the recent bonds that we had over the last 10 or 15 days. So if you look at the last 10 or 15 days, people will tell you, you know, there is a huge rotation. Yes, there is a huge rotation because it has been extremely violent on one day. But if you look at the long-term picture, we are only talking this small move. Okay, so this is not, as always, when something reverses, the question is how strong this reversal is going to be. But so far, let's go back here. Here I put you the two charts that I find interesting. The top one is the Russell 2000 versus the Nasdaq Composite. Daily performance is 1987. So you can see that it's like a heartbeat beeping. Sometimes there are big moves. So that was in 2000. There is a bit more noise around the financial crisis. And recently there was a lot of noise. But if you look at the same chart since 2015, that nothing was really beeping that much. It was much more like the Nasdaq was outperforming the Russell. Then suddenly, for March, there was a lot of noise. So look again at the different time frames to generate ideas and to understand the factoring. So when we look at factoring, when we look at rotation, look at 1 day, 5 days, 1 month, 3 months, 5 years, year to date. Because that will impact massively your ID generation and your portfolio performance. So if you look at what happened last week, last Monday, and this Monday as well, is we had big move. So that's probably the move that was last Monday when we had 5% or more. And this move happened once every 10 years or 20 years. So the move that we had on the 9th of October, so Monday, when we had the vaccine from Pfizer. So here, this is the performance of the Russell 2000 versus the Nasdaq Composite on a daily move. So we moved 5.1% in favor of the Russell 2000. So that was the biggest move over the last 20 years. So clearly, for people, and we were in the market that were telling us, you know, rightly so, that growth was outperforming, that growth was doing well, being long in growth. So from March to the start of November, people were positioned like this. And suddenly, when something is extremely outperforming something else, when you have a reversion to the mean, the reversion to the mean based on the performance and the positioning of many people is extremely powerful. So I can tell you that some of my mentees suffered, some of my mentees made a good money on it, and you have some professional as well, long, short, most of the time, who were making decent money, and over 2 to 3 days, actually their whole performance for the year has been is gone. But in terms of factor rotation here, that is, I think, what is interesting from this BOFA survey is always trying to understand what is the positioning of the market and what are the expectations. And so now people are expecting small caps to be doing well. They're expecting emerging market to do well. So when you are at the end of the year and people are telling you, oh, you should be small cap for next year, emerging market for next year, cash is shite, staples are shite, value is going to do fine. I'm not saying that you should be contrarian, but you know already the positioning of the market. You know, not the positioning, but the intention of the market. So that has been suddenly, over the last 10 days, the talk of the market. If we go back into the picture that we, the chart that we have, Russell versus the Nasdaq, we are still in this consolidation phase that we had for the last 3 to 4 months. So again, another interesting factor rotation expectation when the net percentage think small cap will outperform large caps. And that you can see that, again, if you look at the Russell 2000, which is making new highs, where people or market participants have been putting a lot of money into those indexes. Here we have, similar to what we discussed just before, is the IJR, which is the iShares small cap ETF versus the SPY. So in the sell-off, which was here, small caps underperform massively, the S&P, and since then we have recovering. Okay, so we need to look at the picture. That will be the same as looking at the Royal Caribbean and say, look, Royal Caribbean has been doing very well, and actually you will see that over the last year it has been doing very poorly. So don't be confused by the timing. Don't be confused by the time frame here. Now I would like quickly to discuss sector rotation through the ETFs. I tweeted today on it. If you go and if you use ETF.com, there is a nice way of looking at where were the inflows and the outflows from each ETF. So here, this is from the election. So this is from the 4th of November to yesterday evening, and looking at what has been seeing inflows and outflows. So there has been a huge inflows of money coming into stocks. Okay, so that's for the SPY, for the S&P. 11 billion, that is a lot of money, but that's a VTI as well. What is interesting is the names that we mentioned before. Anything that is a value, that is industrials, meaning cyclical, has been outperforming, not outperforming, but has been seeing some collect in money. On the other hand, gold has been struggling, bonds have been struggling. So the flows has been the flows have been following, or the price action have been following, should I say, the flows that we have been recording. Similar, if we look at since the COVID vaccine from Pfizer, similar, a lot of SPY, a lot of market value. International stocks should outperform. We have another value, we get small caps. So all the names, all the sectors that or the strategies or the factors that were struggling are now or have been over the last 10 days recording a lot of inflows. On the contrary, we see that gold has been the big loser. We are talking 2 billion, which is quite high. I won't be surprised actually to see a lot of gold outflows going into Bitcoin because gold is obviously seen as the end of the world, or fiat currency, or governments are useless, or anything you want to mention, and people are switching a lot of this probably from gold into Bitcoin as well. Sector rotation, finally, next 2 slides, thinking about performance. So here we are looking since the election, what have been the top winners. So top winners, oil services, so the XLE, as we discussed, XLE bounced back by 30%. Energy, anything that is the reflation, reopening of the economy. On the contrary, we get some of the biggest winners, which was social media, but actually it's only down 3% since the election. So after the run that it has, being done only 3% is almost insignificant. But for the gold, it was significant. I think if I have one advice to give you is, I know most of the time retail traders and my mentees, they have a tendency to have too much exposure in silver and gold, and because they will tell me, look, I have 40-60% exposure because it's going to be safe. It's safe. It's against the end of the world. The thing is, gold has been moving quite a lot. If you had 60% exposure from the top to the bottom, recently you are losing 60% times 15, so that is 10% of your portfolio, of your performance. So make sure that your gold exposure is not, let's say, too big, because I know what people are gonna tell me. They're gonna tell me, oh, this is a strong conviction. Any trend is a strong conviction, but with gold, people are most of the time putting aside their risk management on the idea that gold is different and gold should not be considered as the other asset class. Reality, if it's trading at 1850, if it goes to 1750 or 1700, that is not the end of the world, but in between, you could be losing another 10%. So be careful on your exposure to gold. Sector rotation now, since the vaccine announcement, again, oil services on a tier, regional banks on a tier, sub-cyclical, obviously, sectors or sectors that were industries that were closed from the COVID and are still closed. So really the difficulty now is, on one hand, we get the vaccine that is the vaccines that are probably coming in the next 3 to 6 months. In the meantime, we get most of the economies in the Western world that are still going to be suffering. We get, as we said, Thanksgiving, and Thanksgiving, if we have the numbers of cases and death, we're not going to have a full economy, at least for a couple of months. So that's going to have some impact. On the losers, again, think about, the noise that you had recently. Technology is almost flat since the vaccine. So this is not the end of the world if you have been long growth. It was an issue if you are long growth and short value, because here the short value is 10% in your face, okay, over the last 10 days only. But if you are only long technology, there is more noise than actually huge pain. At the end, at the bottom, we see again silver and gold miners have been really the two laggards. And again, saying it, risk management. I know retail world look at gold and silver as very safe haven. safe haven when it goes down 10, 15, 20% in your face. And as I said, when I prepare the US election webinar, I said to people, you know, after the election for a month, gold was down 10% right after the election. So at the start of December versus start of November, gold was down 10%. Guess what is happening here? Gold is down 10% as well. And again, the positioning coming into the election was very long the gold, very long the silver. That means if the positioning is already extremely strong, it doesn't ask much more for this positioning to reverse to the mean. Quickly, my education, the 4x4 video series. So that is a comprehensive online video course that I launched last year in October 2019, where I use very similar to what we've done today. And I try to generate ideas the way I've been generating trades for the last 20 years with 4 filtering processes. I use top-down, bottom-up, special situation, and active trading. When you buy the 4x4 video series, you're going to have 40 plus videos, 30 hours of footage plus 50 Excel spreadsheets. Why? Because I want to help you as much as possible to build your own infrastructure. There are testimonials on the website. For more information, you can send me an email. I might normally be having a new website soon. So that's pretty exciting. Mentoring program. This is one-on-one session on Skype, 1 hour to 90 minutes, where I'm going to help you over 12 sessions to build your portfolio. So that will be first building your infrastructure, then generating ideas, fundamental, quantitative, macro. That is extremely demanding in terms of time. And I have to be honest, if you are looking for easy mentoring, probably not the case. We are talking about 10, 20 hours at least between one session to another over 3 months. That is the filtering. The process is the same as the 4x4 video series. 101 sessions, I give you documents, I help between sessions. That works pretty well. I had since 2014, I had 70 plus. Since I left the other company, I had 50 plus. So it works well. And if you want to have a free Skype call, I'm happy to have a free Skype call with you and discussing, you know, what we could do together. Seats are limited because, you know, I got 2 new people starting in December. Very often we have new people coming in January. So if you get interest, let me know in advance. That's better for me to know, especially if I go back into trading as well. Q&A session. If you have questions, if you don't have any questions, then this is it. Anything you want to know? Anyone? I can see that there's a Q&A. Okay, let's go here. So what do we have? Oh, Sam, what return should we expect to have this year? Oh, love, that's a tough one. I don't know. What returns should we expect? I don't know. Which returns were you expecting at the start of this year? Look, I mean, it depends on how much time you spend on which strategies. If you follow some people, they will tell you that 100% is easy to do. I'm telling you that you shouldn't. Okay, so Sam, you were expecting 50 to 100% this year, but that did not happen. You're probably following some people on internet, on social media that are telling you 50, 100%. And I know what they are pretending to be doing. I think that if without leverage, you do 5, 15% every year, and then with leverage, you're doing better, I think that will be perfect. I think, Sam, as long as you get a process and as long as you stick with the process, you will avoid all this noise about people pretending, making 50, 100% or whatever. I have been there when I started. When I was doing an internship, I've been there as well. When I was in the trading room, you will always be looking at the guys making, you know, pretending to be making crazy returns. If you can have a good process and a good risk management, I'm pretty sure that next year, Sam, you're going to be doing well. So don't worry. Mark, what do you think about long-term exposure to digital moves? I think there are already people that are covering that nicely on social media, and that are pushing Bitcoin as if they had a position and it was too big a position. So DBS the bank. I don't know. What is the so for bank? That is a session that I did this morning, a mentoring session. You need to be looking at price to book. You need to be looking at return on equity. You need to be looking at sorry, I'm a bit tired, at EPS. So book, price to book, return on equity, return on asset, the quality of the assets, the yield curve, how is the economy, the underlying doing, then we can be discussing. If you, DBS, I might have a look at it. If I have a nice spreadsheet, I'll have a look at it and look at the players in the region. What else do we have? I saw on Twitter this week that there's a divergence between smart money and dumb money, and it's quite extreme. So on that one, I'm always struggling with the concept of smart money and dumb money. I don't know exactly. So probably dumb money is supposed to be retail traders, and smart money is investors. So if you look at the numbers, yes, retailers are most of the time doing badly. I like to better understand, when I'm talking about dumb money and smart money, especially on those indexes, because I think people are calling it a name just to pretend that they are smart themselves, but this is not be the case. Balder, would a company ever short sell its competitor? I'm not sure. I think that's a good question. You'll have probably to disclose your position if that's too big. Maybe you do that. Is it seen as an insider? No. That's actually a good point. If you think that you're CEO of a company that is, I think you're better off, or maybe not. That could be a good long shot, actually. But that is another exposure. You already get 100% exposure plus when you're working for a company and you get shares in it. So would you be adding exposure to that? I'm not sure. Kevin, my friend, do you think volatility will stay in this range for longer? So now we are at 23% implied vol. I think you get this magnet of 20% and below. 23% is a high level of implied volatility. Okay, historically, I'm not saying again, it could not go higher, but we know that we knew that the last 6 weeks were bumped by implied volatility, by the election. Structurally, there are many market participants in Asia, in Europe, in the US that are natural sellers of volatility. Okay, so you have more flows of people selling volatility than buyers of volatility. So you really need a huge distortion in the market for volatility to spike. If you think about, you needed COVID. COVID is huge for the volatility to go up. Look at 2016, 2017, market participants, many sellers. Central bankers want volatility as low as possible. So timing the volatility, you need to think about in terms of catalyst. What do we have if you believe that, vaccine it's going to take longer than expected, and actually COVID could be worse in the next 6 weeks, maybe that's one catalyst. Otherwise, there are many things. Economy is doing better. Leading indicators are doing better. You're probably going to have a shitload of money coming from central banks again. You're going to have a lot of money coming from fiscal stimulus. All of these should dump the implied vol and the volatility. Aurel, should we be looking at the option volume on expiry? On expiry, by definition on expiry, that means that So if we're talking about the expiry, the third Friday of the December, March, and blah blah blah, you're gonna have a lot of volume going into that day because people are closing a lot of position. I think what is interesting is to look at what is volume for me is extremely important. And that is something that when I started, I've said that before. I knew that there was naturally you should be looking at volume. So if you look at NEO that I traded, I think it was a couple of days ago. I mostly trade those names when I see the volume is going to be spiking on the day. So I know that as the volume is going to be over the roof, if there is one day to reverse or if there is one day to happen, this is when the volume is pretty big. Okay, so a couple of days that was NEO. Yesterday I traded Palantir, and you could do the same. And I think what is important is what you're saying, Aurel, is because the option market is so big, you need to be monitoring the volume of options on the single names on the overall market, and that's going to give you a lot of indication of where could be the next move for the underlying. That's it. I think that's it for today. I hope it helped. If I haven't answered your question, oh, Neil, last one from Neil. What high frequency short-term economic leading indicators do you monitor? I mean, if I tell you that I'm looking at the market as a leading indicator, that would be a bit of a cliche answer, but that is true. I really like the price action, you know, the drilling that we discussed in the past when you've done the mentoring, which is, you know, looking at the drilling. If you look at the leading indicator, what is nice as well, in the US, you're going to have 4, 5, 6, 7 local or small Fed leading indicator. In Europe, you do have like the ESI as well. You're going to have 1 week to 10 days before the PMI flashes, which going to give you some leading indicator. If you look at something that we discussed in July, which is the chemical barometer, that's going to give you another leading indicator. So you have small ones that are interesting to follow. If you, there is the ECRI weekly as well, every Friday, which is quite useful. So you're going to have several of those. I'm not sure that is answering your question. James, are you surprised that TAN Solar isn't performing better given Biden and the mood? I think for the TAN Solar, so now TAN is at 75, it was at 55, 60. So we had this, let's say 25, 40% move quite quickly, 30, 40% move quite quickly. On one hand, you can argue that because we don't have a full Democrat, both on the House, the Senate, and as Biden, it's not like a flush, and they're gonna. It's not as positive as before. On the other hand, if you look at the drivers, I think the drivers both on the ESG investing. You live in London. You know that London is big in making moves into electrical vehicles. I mean, the question is about solar, but electrical vehicles is the same. The next 10 years, like it or not, we will have to change everything. And the thing is, politicians have been making the decision that we all will have to change. So there is huge driver. Having said that, if you look at TAN and solar, you do have like some names in terms of valuation. Because when you do the mentoring, you know, you always come with those pump up stocks. And those stocks are on crazy valuation. In 2006, 2008, the TAN Solar, we had the same story in the US and we had the same story in Germany. So we had all those names that were pumped up. My view a bit is solar. There is a lot of If you think about solar, it's a bit of putting a semiconductor on the roof. So that means the technology after a year or two is down the toilet or has to change. So I'm a bit, the difference between 2008, 2009 or 2007 is now there's a clear will from politicians that they will force us to change no matter what. So there is a driver. I think for the US, many names have been pumped up. I think in Europe, most of them so far have been private companies, but there are listed companies that could be interesting. If you look not at solar, but if you look at wind, if you look at Vestas in Denmark, that is one of the names that benefited massively as well. Okay. Okay, last one from Jure. Sorry, Jure, if I'm not pronouncing your name well. How should one look at stock index when resistance is broken and new highs are being made? So if I give you following the trend, yes. If I give you the bull trap, that's a no. And that's the difficulty of a breakout. That's the difficulty of those strategies is if you look at the gold, when it broke these 1900 and went to 1950, then it was a bull trap. And then it reversed. So that means the good thing about breakout is normally you have a clear stop loss. So if you say it breaks 100 and it's above the 100 and it goes to 100, 215, then if it goes back below the 100, just cut the position. Okay, so don't say, oh, it's a fake, I'm not, you cut. That's the only thing you can be. But if you look at the Russell, you know, the Russell seems very strong. And again, what is your downside? What is your protection on the way down? It's the where we had the breakout. Okay. Aurel, where we can find the earnings estimates, you get some good websites to find the earnings estimates. You can go on a website like Yahoo Finance, Reuters. If you pay a bit, you can have very good platform as well. Yeah, that's it. Yeah, Nordex as well in Germany. Not in Germany, but yeah, Nordex GY. Yeah. Next week, unfortunately, not because I'm lazy, but because it's Thanksgiving, there's not going to be Market Thursday. So next time is going to be in 2 weeks. If you have questions, again, and you think that might help, please send me an email or social media. If you like what I like, if you like what you see, please like or retweet those webinars, because that helps for the traction, and that helps having new followers, and that's always a good thing when you try to teach people. Thank you very much to all of you, and enjoy this end of the week. Thank you. Bye-bye.